and we want to talk about both sides of it. You'll see that we're going to first run through several changes as it relates to individual taxpayers. Then we're going to follow up with estates and trusts. Following that, we'll be going through the business changes as it relates to both to payroll taxes and other deduction and tax credit provisions, and some new reporting requirements for 2013, and finish off with our big winners and big losers. And kicking off into the individual section, as most of you have heard, we've been able to extend the Bush-era tax cuts for most of our lower income individuals, lower income being a relative term. The new top tax rate of 39.6%, which is up from 35%, has been imposed on those with income in excess of $400,000 for single taxpayers, $425,000 for head of household taxpayers, and $450,000 for those married filing jointly. This is the tax rate table for our single taxpayers for 2013. Even though the tax rates are up on the top earners, because of inflation adjustments, there's actually about an additional $5,000 of income that you can earn this year that's going to be taxed at the 33% or lower rates as compared to 2012. The same holds true for the married filing jointly. Again, there's about a $5,000 differential because of the inflation increases, but as you can see, at $450,000, we are now subject to the 39.6% marginal top tax rate. As always, because there is a graduation of rates, so you're paying part of your income tax at 10%, part at 15, 25, and so on, and it's only once you hit those top dollars that you're now paying every dollar beyond that in at the top tax rates.
Heather, if I could just interject, I think it's important to put this in perspective a little bit. I did a little research this morning about U.S. Treasury, which is required to publish. Little technical glitch there that we worked through. Anyway, I'd like to put this into perspective a little bit. These the higher rates, because it was a political bombshell, as everyone knows, as to how they ended up at the income levels that they did. But a recent study by the U.S. Treasury that's required by Congress that I looked at this morning indicated that in 2009, out of 142 million tax returns, only 4 million tax returns had income over 200,000. That's 2.8%. Now you double that and go to 400,000 to 450,000. The number of taxpayers actually in this bracket has to be less than 1/2 of 1%. So I think this was designed very carefully not to affect very many people. So the high rate really for hopefully all of you out there are in the upper echelon and having to deal with a 39.6 rate, but it really doesn't look like it's going to affect all that many folks.
Thanks, Jim. Moving forward into the Medicare surtax. This is some surtaxes that were put in place to help pay for the health care reform, aka Obamacare, that were set in place a few years ago but are actually just now taking effect January 1st of 2013. The unfortunate part of this is that it's hitting more individuals than just the top tax rate people. There's two pieces of this surtax. The first is the 0.9 tax on earned income. This is based on your compensation, and you can see on our chart here the income. This is the compensation levels where this begins to impact you. So for singles, it's at 200,000. For married filing joints, it's at 250. This is on your actual payroll or your self-employment earnings, and we'll talk a little bit later about how this is going to be impacted as far as your payroll withholdings go, because there are some sneak attacks in here. The second part of this is a 3.8% net surtax on net investment income. The determination on whether you're subject to this one is based on your modified adjusted gross income. That's what the MAGI stands for there. So when your income is hitting 250 for those married folks, you're going to become subject to this particular surtax. If we go ahead and flip to the next slide, the net investment income for that 3.8% surtax is made up of the following items. And as you can see, it's typically what you would think of as investments: your interest and dividends, annuities, royalties, rents, capital gains, but that one's a little bit limited, I'll talk about in a second, and your passive business activities. As far as the capital gains go, if you were to sell a business that you are currently active in, that surtax is not going to apply on that particular capital gain. This is only for your general stock transactions with your brokerage houses and anything that you're not actively involved in. There was a lot of emails that went out several months ago that this was going to hit all of your personal residence sales. A lot of people were scared by that. I got that email from dozens of clients, and essentially, for those of you who are concerned about it, if you have gains in your personal residence at this point in time, you always have your personal residence exclusion, $250,000 for single and $500,000 for married couple, that is excluded before this ever impacts you.
Heather, I'd like to also ask the audience if anybody here in Florida has any gains on the house. I'd like to know where you're living. But, so we have a long hole to crawl out of before you're going to get stuck by any tax on your personal residences. So don't fear.
Okay, the earned income surtax, like we mentioned, is on your compensation, and there's a couple ways that this could potentially sneak up on you, and you end up owing a little bit bigger tax bill than what you're used to seeing. The first situation we show here is when you have a married couple that's filing jointly. Each spouse will not have any additional Medicare surtax withheld from their pay until they hit the $200,000 limit. So in this particular case, spouse one's making $200,000, spouse two's making $100,000. Neither of them has had any of these surtaxes withheld from their pay, and so they end up with $300,000 of total compensation, which is in excess of the $250,000 limitation. So they now have $50,000 of their compensation times that 0.9% earned income surtax. So they end up owing an additional $450. And that's going to show up on your individual income tax return. In the second situation, it's a single individual who's worked for multiple companies during the year. So he's worked for company A, made $150,000, worked for company B, made $100,000 more. So he's now individually made $250,000. The limit on singles is $200,000. So again, it's a situation where there's $50,000 being taxed at this additional 0.9% surtax. If you're concerned about this particular situation creeping up on you, if you know you're going to have this problem, there's a couple things you can do. You can fill out a W-4 at work to revise your federal income tax withholdings and bump them up by the amount you think that you'll be falling short. Or you could choose to make quarterly estimated tax payments due in April, June, September, and January, and go ahead and pay in some additional at that point. Or you can just wait and pay it in with your personal return. And feel free to give us a call if you're of concern on this, because it doesn't just affect the numbers in question where it's $450 of tax. If you and a spouse were each making $199,000, those numbers would creep up even higher. Talked a little bit on the net investment income as it relates to the Medicare surtax relative to active versus passive involvement in business entities. And you've always been required, if you've got S corporations or partnerships that you own and you're putting those on your personal tax return, you've always been required to show them as either passive or active. But the real concern everybody had in the past was related to passive activity losses being limited. In this case, we actually have passive activity income being taxed additionally. So you really need to consider how you've been reporting that up to now and really think about whether these are passive or active to you, because it is going to cost you an additional almost 4% on your passive activities at this point. And if you're not sure if you're active or passive on this, here's some of the general material participation rules. And I'm not going to run through all these. Chances are you know how involved you are in your business, and there's some situations where we can also perform some groupings which would allow a couple businesses to be grouped together and perhaps hit these requirements, whereas you may not for standalone entities. As it relates to partnership holdings, if you are a limited partner, currently you're not subject to self-employment tax, but you are now subject to this surtax on the net investment income. On the flip side, if you're a general partner, you are subject to the self-employment tax, perhaps. We can talk about that further down the road. But you are not subject to the surtax on net investment income. So there's a dynamic going on here, and it turns out the impact of these basically offset each other completely. So we really need to evaluate the way you're being treated within your partnership entities now, and how those are going to be taxed, and see if there is a benefit one way or the other to you. Now the answer might be, well, I'm an LLC being taxed as a partnership, and maybe it's time to consider whether we convert to an S corporation. S corporations at this point are going to be a more beneficial planning opportunity entity, it looks like. So we want to make sure that if you've got an LLC being taxed as a partnership right now, we consider conversion to S corporation, because it is going to limit your exposure to the surtax. There are other downfalls to S corporations, so I'm not saying everybody should do this, because there are some inflexibilities that you are able to get away with some additional things as a partnership, but it's definitely time to reevaluate this.
Yeah, that's very interesting as you look back on history, and I know Brian goes back a ways too. We talk about the 1986 Tax Act, but coming out of '86, partnerships were virtually killed by Ronald Reagan, and the passive activity loss rules came in, and so everybody moved into S corporations. And then about 10 years ago, the legal community developed the LLCs, which give us incredible flexibility, and that became our entity of choice. And we pretty much said the S corp is now dead, and we started to move on to other forms of entities, with the LLC and the partnership being our preferred one. And now with the dynamics changing, and those of you like algebra, the formulas are all changed again, so we're going to have to reconsider the entity choice thing, which was kind of a no-brainer for us for the last 3 or 4 years. So it's good for us, not so good for you.
Brian, let's turn it over to you to continue talking on the individual side for us.
Thank you, Heather, and welcome everyone again, and Happy New Year. I guess the year started off with most of us having the flu, and then we got this Tax Act flu at the same time. Going back to what Jim said on the entity choice, it's interesting because more and more of the entities become more of a legal issue as opposed to a tax issue. And sometimes we're torn between which way to go. But I'm going to talk a little bit about probably what is pretty interesting in the capital gains. But let me just start by this act extended quite a few things, good and bad. One of the things that it did not extend was the phase out of personal exemptions and itemized deductions. So as it stands for the last couple of years, no matter what your income level was, your personal exemptions, you, yourself, your spouse, your kids, were not phased out. We got the full deduction for each one of those. Same for your itemized deductions, real estate taxes, mortgage interest, charitable donations. We didn't lose them. Beginning in 2013, that changes. Personal exemption in 2013 is worth $3,900 per person. If you're a single person, that's going to pretty much be phased out if you're up in the $372,000 range. If you're married filing joint, about $422,000, it's going to be phased out. So that's another little add-on to any potential increase in tax rates that we can calculate, and there's going to be another slide later that shows the effective impact of some of these phase-outs. Also, you either are able to itemize your deductions or take the standard deduction. The standard deduction next year for married filing joint is $12,200. It's half of that for a single person. Once you're over $300,000 for married filing joint, if you're able to itemize, it's going to start phasing out. the good news is no more than 80% of your itemized deductions can be phased out, and certain itemized deductions are not touched, such as medical, the investment interest, which you can only take if you have investment income, casualty loss, gambling losses are excluded from the phase out. So can we go to the next slide? Let's talk about, I think, what is of interest to all of us, and I know here we spent quite a bit of time talking about this. Capital gains and qualified dividends. For the last number of years, as all of you I'm sure know, qualified dividends are taxed at no more than 15%, and long-term capital gains are taxed at 15% as well. So we've been hearing over the last few months that these were going to go from no more than 15% to whatever the top bracket was going to be, which we all pretty much were aware was going to be 39.6. I know there was a lot of tax selling, profit taking going on, and there's nothing wrong with that to lock in profits. However, obviously at the last moment, our friends in Washington decided to raise capital gains and qualified dividends to no more than 20%. However, that's only on singles that have adjusted gross income of $400,000 or marrieds at $450,000. So anybody below that, Heather showed us the brackets earlier. If you're below 400 as single and you're below 450 for married filing joint, literally nothing changes. The brackets don't change. You may lose there may be some phase out of your itemized deductions and personal exemptions, as the last slide indicated. But as far as your brackets and as far as the capital gains rate, no change. You get over 450 and we go to 20% if you're married, over 400, 20% if you're single. If you're under, if your income is taxed below the 25% bracket, so in the 15 or 10, your capital gains is actually taxed at 0. So the next slide, the slide we're looking at now, indicates that. So a lot changed, and a lot can change, but the real changes really don't start kicking in until we get over these. We get into the 39.6% bracket, and at that point, a lot of things can change. So if you're in that range, I can't emphasize enough, there has not been that much of a change on your personal tax return. So that's it for capital gains and qualified dividends. Just looking at 2013 on this one slide, the way we're showing this is you can see if your dividend is not qualified, you're taxed at the ordinary rates. If it's qualified, you're good till you hit the 39.6, and then you're at 20%. We're also going to talk about trusts in a little while and how they're impacted by this as well. This comes up quite a bit during the course of a tax season, and it's something that we're very aware of, and our clients that are in the alternate minimum tax are very aware of. But most taxpayers that are in it aren't exactly sure why they're in it, and it's very hard for us to tax plan and determine if you're going to be in it. We can figure it out, but a lot of things can change. So the AMT, just briefly, is an alternate way to calculate tax based on your original taxable income, but certain deductions that were allowed in the original are disallowed for AMT, so they're added back to your taxable income for AMT. Just briefly what those are, and then we'll talk about how this new tax act is going to impact this. The items that get added back, part of your medical expense could be added back, taxes, real estate tax, sales tax, state income tax that are an itemized deduction. Now in Florida, we don't have a state income tax. Some of us have, can be substantial real estate taxes, or if you own more than one property, the real estate taxes. Those are add backs. Usually when we see a large tax item as an itemized deduction, we start thinking AMT could come into play. Any of you that are involved with startups and have incentive stock options, that can cause you some headaches in AMT. But for the most part, they've made this exemption permanent. that may impact you, it may not. It's just better than not having it permanent. The exemptions were set to expire, remain at a lower amount, but for the past few years, at the end of every year, the exemptions were raised up and helped many people avoid AMT. And the way AMT works, if you're in the $250,000 or $300,000 range and you have quite a few kids, because exemptions can be added back for AMT, and high taxes, state tax, real estate tax, there's a good chance you're going to be in AMT. AMT is either taxed at 26% or 28%. So if you have a lot of 15% income, the qualified dividends, capital gains, then some of these add backs from deductions against ordinary income, there's a good chance you're in AMT, and we have to calculate the tax twice. Whichever is higher is what you pay, the regular tax or the AMT. Just kind of taking this a step further, and we may talk about this a little bit later, as your taxable income grows and we get into this 39.6% bracket and 20% capital gains and qualified dividends, there's less of a chance you're going to be in AMT because your average tax is going to be higher than the 26 or 28%. In that case, it would be 28%. So we're hoping that we see less AMT, and we think this act at the higher incomes may have caused that, which hopefully will be so for some of you that are in it.
Brian, the AMT is probably the most cursed three letters that I hear from taxpayers, and it's one of those acronyms that everybody throws out at the holiday parties. Brian, are you in AMT? Yeah, I sure am. It's kind of like 401k and Section 179. Some of these things actually bleed into our social functions, but the AMT has been a very it's a very bizarre thing that we have in the United States. We have two very complicated tax systems. You would think that one complicated tax system would be enough. But one of the silver linings in this act is the very fact that 60 million people, 60 million average taxpayers were going to be covered by the AMT had they not made this correction. And those are people that it wasn't intended to fight. It was supposed to catch people like Warren Buffett, that it hasn't, and folks of that sort. But also, as Brian pointed out very well, as your regular income tax goes up, we're going to see fewer and fewer of our more well-to-do taxpayers falling into the AMT as well. So this is a good thing that's developed with this tax bill.
Thank you, Jim. Next slide, please. Some of the other items that were extended, and this happens to go through 2017. Credits for higher education, deductions for higher education, they're still around. We get a lot of clients that come in that are paying substantial college costs, and this is what we're talking about, college, not high school. If you're over these income limits, 80 for single, 160 for married joint, you're not going to get the credit. They're going to be phased out. Some other items, there is an above the line, which means it's on page 1. A deduction for qualified tuition. Once again, there's a fairly low phase out on that. If you have those expenses, bring them into us. We calculate it every which way, and sometimes it's a partial. You'll get a little bit of each, and any little bit helps. Just don't let these phase outs bother you. Bring us the information. Now, another item that is, I guess in Florida, is probably fairly important as well as the rest of the country. The exclusion from gross income or the discharge of qualified principal residence of the indebtedness. It's up to $2 million. That's only for 2013. And basically what that's talking about is you lose your house or it's a short sale and any mortgage debt is forgiven. You got to be careful with this. We have to know the basis of your house. You could have an issue with some borrowings if it was in excess of your basis back in the day when the fair market values went crazy. But for the most part, this is still here. It was a politically correct item to keep in, and they did, and we're happy that they did.
Brian, if I could just add the fact that
okay, Jim's still alive. Something happened over there. these items have been around, and for a lot of our teacher clients, there's a $250 deduction for your out-of-pocket supplies. We know how much teachers spend out of their pocket. This is a page 1 deduction. We try to get it for as many people as we can. This mortgage insurance premium treated as qualified residence interest, I think we collectively had, between all of us here, 1 or 2 people last year. And then the very last item that we talked about earlier that impacts AMT, but state and local taxes, sales tax, etc., are still an itemized deduction. That was set to expire. And as we were doing tax planning in November and December, I had a lot of clients come in and say, I bought a new car, I bought a boat, I bought this. At that time, this was not going to be allowed. So at whatever time on New Year's Day this went through, they extended it. So for everyone that didn't think they were going to get it, you're going to get it this year. Be careful, though. It's one of those items that gets added back for that 3-letter word AMT. But then again, bring it to us and we'll see how it works.
All right, Brian, after I clicked on there, I remembered what I wanted to point out. Those of you that are on the fence with a short sale, and this is very common in Brevard County in Central Florida, it's if you have a house on the river and with a huge mortgage and you were to do a short sale, just to put this in perspective, if you had $1 million of debt forgiveness and you happen to have a really good year this year, we're talking about $400,000 worth of tax. That if you did this short sale in 2014 versus 2013, or if that's $100,000 of mortgage forgiveness, and those things are happening all over Florida and all over the country. And I wouldn't bet on this being extended into 2014 because the housing market is coming around. The debt ceiling discussion is going to happen. So I would certainly move on these short sales if you're considering them.
And hopefully with the real estate market coming back, it's not an issue. You make up the deficit. This next item is fairly important, and I'm going to try to go through it and explain it carefully. I think some of you, I know a couple of my clients on here have done this in the past, but just to give you a little bit of a quick background. If you're over 70.5, you're required to take a minimum distribution. We call it the RMD, required minimum distribution from your IRA. For the last couple of years, you were allowed to have your trustee, your IRA trustee, make that distribution directly to a qualified charity. If that was done, you satisfied your required minimum distribution, whether it was $1,000 up to $100,000, and it literally stayed off your tax return. Whatever you took out was not taxable. The charitable donation did not show up, but in effect you got the charitable donation. If you had $50,000 directly, it didn't go. It was a wash. You didn't pay tax. You didn't show it on your tax return. You didn't get a deduction. It's the same thing as putting on your tax return and getting the deduction, but we'll talk about 2013 in a minute. So we had some clients that wanted to do this, and as of December 31st, this thing was dead in the water. Lo and behold, with the this Tax Act, in their infinite wisdom of timing, I guess on the first day of 2013, they said, whoops, we're going to let you do this for 2012. So how are you going to let us do it for 2012? Well, this is pretty much how it works. If you took a distribution in the month of December, you have the month of January. You can make an election. They haven't told us exactly how it's going to look yet, but if you took a distribution from your IRA, you have the month of January to make a donation, and we can treat it as one of these tax-free distributions from your IRA like we could in the past. It's an election we're going to have to make in your tax return. You have to do it by the end of January. So that's a good thing. If you missed your required minimum distribution last year, you actually have some time in January to take it out and make an election and have it go back to 2012 if it goes to a charity and take care of the same issue. It takes care of your RMD, it goes to a charity, there's no impact on your tax return. So this is good. It extends through 2013. So talk to your advisor. If you had done this and you still want to do it and you don't want to do it, you can do it in 2013. You can do it this month to take care of last year. If you did it in December, took the RMD, we can deal with the charitable impact of it if we make the proper election with your 2012 tax return. This is actually a good thing. I don't know why they waited so long. We pretty much knew they were going to probably do this and give it back. But if you have any questions on this, it could be some tax savings, especially in 2013, as we talk about the 450 and the 39.6% bracket and the 250,000 for the Medicare surtax. By making this election and having your IRA go straight to a charity, it stays off your tax return, so it does not increase your adjusted gross income. It's a pure 100% tax savings. It could have other impacts as well, as far as keeping you out of 39.6 bracket, keeping you out of the Medicare surtax. So it's something that we need to look at in 2013. But it's unfortunate we have to hustle in the month of January to make it work. Oh, and we have a few other credits here that have existed. Briefly, most of you are aware of these, but there's limits. $200 for windows, $500 for other energy efficient things in your home. These are lifetime limits, but for the most part, if anybody has any questions on these, just contact us. We don't really want to spend a lot of time going through that. I'm going to turn it over to Mr. Laham right now, and thank you very much.
Well, thank you, Heather and Brian, for doing the really difficult part of this presentation. That was a little beyond my scope, but I have the fun part of the presentation now, and so all you folks out there that are playing Office Jerk on your iPad, I'm going to have to ask you to pay attention now a little bit, because this is going to be a little bit interactive, as interactive as a webinar can be. First of all, I hope you've all enjoyed the nice lunch that we had brought in from Bobby Flay's Mesa Grill. I especially like my smoked shrimp tacos. They were delicious. So, well, anyway, a pun was intended there, and I understand you're probably having a little tuna fish sandwich and having a little indigestion as you're following all the tax changes here. But I want to go in. I found this article in the Wall Street Journal on early January, and I thought it was a really interesting. It's a full back page in the Wall Street Journal that puts into focus a variety of folks that have been impacted by the new tax law. What I found really interesting here, now I want you to look at this carefully, and what jumps out at you? Well, just kind of take a look at it, other than the tax consequences. Obviously, that's what we're focused on. But I found this to be pretty interesting. First of all, here's what I noted, being a very observant male, that women are all in the foreground in this picture, and they all are in control.
As they should be.
As they should. Women appear to be the primary income earners in this picture, in all facets of it. And so there's a little bit of this is kind of an old buzzword now, a paradigm shift. There's a transformation that you're seeing with women being very prominent now in the workforce, and many of them being the primary breadwinners. So I think that's a good thing. Reminds me of a famous song by Bob Dylan, These Times Are Changing, and just thought it was very interesting. The second thing I thought was kind of interesting is everybody in this picture is crabby. They're all sad. And I'm thinking, well, when I looked at it, everybody's taxes went up, so I guess that's reasonable that everybody would be a little sad and crabby, except the old retired couple there, their taxes didn't go up. And Ryan and I were talking this morning. He said, well, they're old people. That's what they do. They complain about everything. So and they said, so that's really not a change in anything. And quite frankly, you'll see them all down at the local coffee shop complaining about this tax act, even though it didn't impact hardly any of them. The last thing I think, if you look at the political ramifications of this picture, this bill was very, very carefully crafted. If you look at the people that really matter in terms of voting, the retired folks are very, very, very vigorous voters and very, very outspoken. This tax bill doesn't affect them virtually at all, so kept all of them happy. And other than the payroll tax cut, the 2% that affects everybody, for people under $450,000, it affects virtually nobody in terms of the tax rates, really. There's a lot of other things that come into play, including the Obamacare surtaxes and things that really just were passed in 2005, just happen to be taking place at the same time. So I think this was politically crafted to put sort of a big tax on the big rich people, which, as I expressed earlier today, I think that's way less than 0.5%.
Jim, you didn't even talk about the timing of the tax legislation coming after January 1st. They let the Bush tax cuts expire so that Congress could actually be imposing a tax cut rather than a tax increase.
Yeah, that's and we have some insider Washington information that Heather wouldn't let me share, because we actually heard this at a conference from a lobbyist, said that technically on January 1 the Bush tax cuts expired, so everybody's taxes went up for a day or a moment. So when they officially record whether this was a tax increase or tax decrease, because you know there's watchdogs in Congress that kill these people that vote for tax increases, this is going to go on record as voting for a tax decrease. So very clever, our politicians, as they play through the smoke and mirrors of today. Now let's go on. We're going to look at some of the folks, and we're going to try to put into focus some of the things that Brian and Heather talked about this morning. This is a person that is single person with $230,000 worth of income. Looks like a Wall Street Journal type, kind of like Heather McDonough. You know, all looking very businesslike. Not very happy, but really not too significantly impacted by this bill, even though she's doing quite well. But when you look at the components, I'll give you some of the components that did increase for this young lady. She was impacted slightly by the 0.9% Medicare surtax. I figure that was somewhere around $200. Her $35,000 of net investment income that Brian and Heather talked about probably cost her somewhere around $1,300, because she had to pay $35,000. The net investment income tax is 3.8%. She also got affected, everybody got affected, any wage earner, self-employed person, by losing the 2% payroll tax cut. That's the biggest factor in everybody here that has a tax increase. That was about a little over $2,000, and she had a slight loss in itemized deductions. So four elements of what we just discussed today impacted this young lady. We move on to the single parent. Kids hanging on her after a tough day, coming home and find out her taxes went up. But similarly, in this particular case, she's impacted very slightly. $5,000 of the 9% or 0.09% Medicare surtax cost her about $50. Her $25,000 of investment income at 3.8% cost her about $1,000, and the loss of that 2% payroll cut cost her about $2,000 as well. And I know there's a few accountants out there doing the math here. We couldn't prove these numbers out exactly, but we got very close. We believe our numbers are more accurate than the source for the Wall Street Journal, because I had Brian Fisher, one of my esteemed colleagues here, check my numbers. So we couldn't get it exact, but these fact patterns, of course, are very very general. Now let's go on to
Jim. That poor mother could also be in the AMT, where possibly she could have snuck in there.
Yeah, she could. Now let's go to this married couple, and Dad's in the back there, just kind of, I don't know, looks like he's got his cardigan on, and Mom's at home with all the kids, and man, they're looking a little miserable because their taxes going up. Let's say the Wall Street Journal says almost $22,000. I think that's about 12-13% increase in their tax burden. And if you live in Manhattan, you probably would, you know, feel that sting. So a couple $1,000s a month almost is pretty significant. The reason I like this one is, first of all, very few people are in this situation, but fortunately, many of you that are out there today are very good business people, and you're doing quite well, and you certainly fall into this area. But in this situation, a married a couple of children at this income level, $220,000 of their wage income is subject to the Medicare surtax. so that's $1,980. $180,000, their entire investment portfolio income, excuse me, is subject to the 3.8%. So that's another $6,800. Again, the 2% payroll tax cut cost them $2,274, and now here's the first time we actually see a significant piece of the phase out of the itemized deductions and the personal exemptions. This couple is going to lose all of their exemptions, and I calculated about $11,000 of their itemized deductions. So this is, we call this the backdoor tax. This impacts them significantly to the tunes of several $1,000s. And I've also isolated the impact of the new tax rate compared to last year. The fact that some of their income now is falling in, $130,000 of their income is falling in the new 39.6% tax rate, that increases their tax about $6,000. So when you add all that up, their taxes are up over $22,000. So that kind of brings into focus how all of these provisions come into play. The next one, we've already said, these nice folks plan very well. They have income of $180,000, which isn't, you know, don't have a mortgage, don't have any debt, all the nice things of retirement, and plenty of ordinary income, but their taxes don't go up at all. And I think that was designed for a variety of reasons, and perhaps they shouldn't have.
Jim, you want to talk what we discussed on the ordinary income and the capital gains right now? It's a good time.
You're kind of the expert.
We had this discussion. We had a call from someone who I believe is listening right now. But the question is, let's say you're married, filing joint, and you've got $300,000 of ordinary income and $200,000 of capital gains. So you're over the 450. The way we've determined that this would be calculated is the ordinary income is under $450,000, so you're not going to be in the 39.6% bracket. You're going to go through the tables that we showed you earlier on your ordinary income. On the capital gains, the amount to get you up to the 450, so in this case, you had $200,000 of capital gains, $300,000 of ordinary, so $150,000 of capital gains is going to be taxed at 15%. The amount above 450 would get hit at the new 20%, plus we have the surtax to factor in. So the question that was posed to us is, if we're over 450 and it's a combination of 15% income and ordinary income, you know, are we going to get hit at 39.6? And after going through and looking how it's been done in the past and reading some items, we don't think that's going to happen. You could be over 450 in your ordinary income, as long as it's under 450, is going to stay in those same brackets prior to January 1 that kicked in. So sorry to interrupt you. I just thought it was a good time to address that.
Thanks, Brian. You know, but using those live examples is very helpful, because crunching the numbers is really what has to be done. The next slide we have here is a creation of Berman Hopkins. We wanted to have something that was totally unique to us. And we thought what we would do is focus on what's the worst case scenario for a particular taxpayer, because there's a lot of rhetoric, a lot of debate out there. What is the real effective rate? So we broke this down. I think it's pretty revealing. Again, this is the worst case scenario in terms of your investment income, but it certainly could affect several people. First of all, if you're more than 450, like one of the previous slides of the married couple that had 650 of income, your top rate is 39.6%. The Healthcare Tax Act tax, which is the net investment income tax, which this investment income is subject to, is 3.8%. Now we've done a little imputing here. We've done some algebra to impute what the effect of losing the exemptions in your itemized deductions is, and that's about 1.4%. So here in Florida, the maximum amount of tax you could pay, even though we don't have a state income tax, on your investment income would be 44.8%. So that's knocking at the door of 50%. Then I have some good friends up in New York, plenty of some good CPA friends, affiliates of ours up in Manhattan, and their tax rate in Manhattan is 12.3%. So those poor folks up in Manhattan, on top of having to put up with the winter, they could be paying tax at 57.1% on their investment income. So that gets pretty scary. And those real estate people out there, man, there's some great reasons to be down in Florida. I just noted the median price for a Brevard home in Central Florida is $146,000, and to save 12.3% income taxes, it's time to move from New York. So I think there's some great benefits, obviously, to living in Florida, particularly real estate market. Okay, now let's look at the poor souls that are just working day to day, like Brian and I and Heather and Sue and Natasha here. Earned income is also taxed at the highest rates, and that's 39.6%. If you're making more than $250,000, we talked about the 0.09% surtax adding on to that. And again, this is going to have, as your income goes up, it's going to have the effect of losing your personal exemptions and also your itemized deductions. So your maximum effective rate on earned income really is not necessarily 39.6, and in virtually, or very few cases, high income earners are going to be much closer to this 41.9% tax rate on earned income. So tax planning is really more important than ever, as you can see with all the dynamics interjected in this new bill. And again, those poor folks up in New York on, you got to make a lot of money in New York. Those of you who've been up there know it takes a lot of money to live. Their tax rate would be as high as 54.2%. Now, I thought it was also important. Heather mentioned yesterday when we were kind of doing a little run through here that I'm always I like to come up with all the pain and agony and the worst case scenarios, because I think that's what people like to hear. It's what the news is all about. But let's put this into focus a little bit. Brian and I have been practicing quite a while, and this graph shows you that where the rates are now that are approaching the highest rates at 40%, if you look historically, everything above where you see on the far right means tax rates were much higher than that. Back after World War II, tax rates, or even during World War II and coming out of World War II, were as high as 90% until 1968. So for many, many years, like 20 years, the top tax rate is 90%, and people always challenge me on that, say that's impossible. But that was the reality. Now, in 1969, there was a Tax Reform Act. We finally had the first change in rates, and I think they settled a maximum tax rate of 70% and 50% on W-2 earnings, and that went on for some time. You don't see a real significant change, and the biggest dip in this is everybody's favorite, at least Republicans' favorite. In 1986, Ronald Reagan brought rates down to a historic low. I think it was the lowest level it had ever been. There were two rates, 15%, 28%. There was no capital gains. Everything was very simple. You got rid of a lot of deductions, a lot of loopholes, and you had two rates, and it worked very nicely for about 3 years until Congress started to bring in other elements, and now we've gone from two rates to dozens of rates, and the system's gotten extraordinarily complicated. But the good news is, in the Western world, France is in the process of approving a 75% top tax rate. Great Britain's at over 50, Norway and the Nordic countries. So there's no place to hide, particularly unless you're going to move to the Caymans and things. So the point here is, it could be much worse. It has been worse even in the United States. did we? Yeah. This is very interesting, and I'll show it in two different slides. This is just interesting discussion. You know, Great Britain raised their top rate to 50%, and very similar in the whole political process that we went through. Now, let me tell you something that's very clear. People that are well-to-do have resources. They are very responsive to marginal rate increases. What does that mean? That means they have great attorneys, great CPAs, they're well represented, great investment people. They find ways around the system. And this slide says, this is very interesting. This is very recent history too. When they raised the rate to 50%, there were 16,000 people who paid in 13.4 billion pounds in taxes. And when they raised the rate to 50%, the same people that reported over $1 million dropped to 6,000 taxpayers, and they brought in half of what they brought in before they raised the top rate. So what does that tell you? That tells you that very smart, well-represented people find ways around the system. So this whole taxing, this $83.6 billion, I don't think it's going to happen. Now, this slide is also very interesting because politically it never gets discussed, but I was at a conference with Heather a year ago, and this was one of the chief economists out of the Federal Reserve out of Atlanta, and he said, an interesting thing goes on in the tax world. And he said, we cannot identify why it happens, but this is empirical data studied by economists that when rates go up or when rates go down, as a percentage of gross domestic product, the total tax, the percentage of tax collected compared to the gross domestic product doesn't change much, which is very interesting, because if you look in '86 when rates came crashing down, the trickle-down theory said we're going to bring in all this extra money because rates are down. Well, that didn't really happen. Nobody can understand, and people will point to that. But also when they raise rates up very high, as I just pointed out, it doesn't really raise a great deal of additional tax either. So again, I can't explain it, but this is something that the economists have been studying for some time, and that's the real deal.
Hey, we have a question here, Lynn. We've been looking at it, and I'll read it and then answer it. Given these new surprise taxes, are they increasing the limit before a penalty applies if you didn't withhold enough and owe too much at the end of the year? Well, that's no different really than it is now. We've got what we call safe harbors that we're required to pay in, and the safe harbor for 2013 will, for the most part, will depend on what your 2012 tax is. So there's multiple safe harbors. It depends on your income tax and your adjusted gross income from the previous year. It's very easy to figure out. So if you're going to owe, you either go estimated payments, or if you need to meet your safe harbor, estimated payments, or you increase your withholding from whatever source you may have. If you miss your safe harbor and you owe more than $1,000, you could have some penalties and interest. So that was a good question, but there's not much we can do about it. So the safe harbor is the key.
And Len, just addressing that directly, yeah, they didn't. There's no special provisions for the sneak attack tax increases. That, you know, the same rules are still there. There's no new leniency relative to that.
All right, we have a couple more questions that are coming through. We have one. Could I write off a charity if we put money into the Kids 529 college savings plan? Let's see, who on our panel can answer that for us?
No.
So that was a nice, simple answer. We have another question.
That's Lynn again. Lynn, it's 110%. But only if your adjusted gross income is over $150,000. So there's multiple safe harbors, and it's only if you think you're going to owe more this year than the prior year.
Yeah, so the other safe harbor would be 90% of the current year tax.
All right, that's some great questions. I think we're going to go ahead and move ahead to the next section to talk about how the state and trust are affected by these changes. I'll turn it back over to Brian.
Okay. I know there's a few people on here that deal with estates and gift tax and trusts, and I know there's a few people that have trusts on here. First, let me say that we were all under the impression, actually, I think some of us probably figured it wouldn't go to $1 million, but as you recall, we were over $5 million last year, and in the estate exemption, the amount you can pass away with without paying estate tax on, it was scheduled to go to $1 million, and I think the consensus was it would be $2.5 or $3 million. So at the last minute, and this is a great part of this whole act, we're back up to $5.12 million for last year and $5.25 million in 2013. And unlike the last forever, it's going to be indexed for inflation. So we should see changes from year to year to year. Now, for those of you that scrambled to reduce your estates and make gifts and take advantage of the $5 million at the end of 2012, it's still a good move. You know, part of estate planning is moving the asset, but as time goes on and that asset appreciates, it's appreciating not in your estate, but in someone else's. Now, that person could obviously have an estate issue. So if you gift it to kids, make sure, you know, planning point, if you gift it to kids, whether they're young kids, old kids, make sure they've got an estate plan as well. Just don't give it to them and let it go. But anyways, it still was a good move. And there's portability. The third bullet item, portability, meaning if you and your spouse don't use each of your $5 million, it can transfer over to the spouse. There's a couple of hoops you got to jump through to do that, but it's doable. The other thing is the top rate is 40%. But if we plan right, we won't have to pay that 40%. Very last item is the gifting exemption for 2013 is $14,000. So that's the amount you can give away without us having to deal with an estate a gift tax return. Now, getting into to trusts a little bit. If you don't know this, trusts are excellent vehicles to control assets, to make sure your wishes are dealt with, whether it's for a younger person, for estate planning tools, but they're horrible tax vehicles. So if you look at this chart, let's just go to the bottom line. In 2013, if you've got taxable income in a trust, it's at the 39.6% bracket over $11,950. Now, capital gains are the same in a trust. So up to $11,950, a trust would pay no more than 15%. Over $11,950, if there's capital gains above that, it's back to the 20%. And to make things even sweeter, the Medicare surtax kicks in on these items. So the moral of this story is, and you can go to the next slide, we can distribute from a trust to the beneficiaries if there's a provision to do so, and a trust is allowed to take a deduction for that distribution and not pay a tax. It flows through to the beneficiaries. It's going to be more important than ever that we plan that right. We may not be able to do it with capital gains, but with ordinary income, it's extremely important that we plan that right and potentially get it over to an individual's tax return, especially if they're under the 200, under the 250 for the Medicare, and under the 400 and the 450 for the new tax. So that, I'm going to leave it at that on the trusts, but for the most part, it's pretty good news with how this act handled this part of the tax code.
All right, we'll give everybody just a minute to see if there's any questions about estate and trust. All right, well, if there is, you can please go ahead and put your question in, and we'll definitely get to it at the end of the presentation. At this point, we're going to go ahead and move over to how the tax changes affect businesses. Sue?
Hello again. The prior discussion has related to the 2013 taxes relating to individuals, and I'm going to briefly discuss the items related to businesses. On the payroll tax level, the federal unemployment tax return is due at the end of January, And like last year, the Florida businesses had a credit reduction that they had to pay of 0.3%. This year, that amount has doubled to 0.6%. The maximum cost to the employee is $42 per employee, and this is also payable at the end of the month. The wage base for the federal unemployment tax has gone to 8% or $8,000, I'm sorry, and matches what the state wage base is, $8,000 for 2013. The American Tax Relief Act of 2012 did not extend the payroll tax holiday, which has been mentioned previously. That tax had reduced the Social Security withholding by 2% for the employee. That now, since it is not extended as of 1/1/13, that tax went back to 6.2%. The wage base went from $110,100 to $113,700. That is both self-employment income for Social Security as well as W-2 wages. Now, Heather and the others have also previously talked about the 0.9 additional Medicare tax. But on the employer side, once an employee earns $200,000, the employer has to start withholding that 0.9% tax. Even if he has an employee who, let's say, has a salary of $250,000 in the calendar year, the withholding does not start until that employee reaches $200,000. There is no match to the employer, and this amount will appear on the W-2. Just to reiterate, as to the employer, if your employee wants additional tax withheld, they prepare a Form W-4 and ask for additional federal income tax to be withheld, which goes towards your overall tax liability. Outside of the payroll tax realm, there is a new reporting by credit card processors. They have to provide recipients of credit card fees, sales, in the form of a 1099-K, and this form, we ask that you give this to your tax preparer because we need to fill your gross income is reported on 2 lines this year, whether you're a sole proprietor, a partnership, or a corporation. One of the lines is sales receipts from credit cards, and the other is other. So the 1099-K, which you will be receiving from the credit card processor, is reporting the gross amount. It is not reduced by fees, it is not reduced by income or discounts or refunds. So it is the gross amount, and you need to give that 1099 or multiple 1099s if you have multiple processors to the tax preparer. This 1099 can be issued electronically. So for those of you who are trying to go paperless and you're getting most of your reports electronically, please watch for this form to show up and either forward it to your preparer or print it out. And if you can go to the next slide too, that shows the what the 1099 looks like. So I'm going to turn this back over to Jim, and he's going to continue with the business credit and deduction extenders and a wrap-up of our webinar.
Well, thank you, Sue. Good to be back. In looking at the developments here, the business side of this tax bill is extraordinarily favorable. It's very good news for business people. Almost everything that concerned us got extended, and loopholes or favorable provisions remained intact. The biggest ones, and some of them were actually enhanced along the way. The biggest one is Section 41 is it's the credit for increasing research and development activities. This applies to many of our clients, and a lot of taxpayers actually don't use this and are eligible for it because the research credit really is fundamentally can involve processes that you don't have to find a new vaccine for polio or the flu to get this credit. many taxpayers are in the business of research and development. They don't realize it, so it's something you need to bring up to your preparer. It's something we use a lot. So that got extended. So that's very good news. The Section 179 limit on expensing equipment was extended to 500, or was actually went from 113,000 to 500,000. That means you can, if you buy new or used equipment in 2013, you can write that off dollar for dollar. That can be a huge benefit for somebody that's in the in the heavy capital area of the business. So we're very happy with that provision. And on top of that, they put back in the bonus depreciation for 2013, which basically says you could, the way this would work in sequence, you expense your first $500,000 of everything, then anything beyond that is you can take 50% of the cost in the first year and then depreciate the balance as well. So you end up somewhere around 60-65% of that acquisition be expensed in the first year. So those people that have capital intense businesses, this is a really good bill and something you may want to consider because as we come out of the recession, those little goodies are going to go away. Onto the work opportunity credit. This was extended as well. This involves credits for hiring veterans, people on welfare and assistance, and one that I haven't quite figured out, qualified ex-con. I'm not sure what a qualified ex-con is, but that's actually in the statute. So that those credits also got extended. Now here's a little bit of a sleeper. This is a little bit complicated, but it's a problematic thing. I'm not going to get into detail here, but if you have an S corporation that or a C corporation that converts to an S corporation, they have to wait 10 years to get outside what is known as the built-in gains tax, which basically treats any asset sold that was on hand at the date of conversion in the next 10 years as if you were still a C corporation. So we end up in this sort of double tax proposition. But somebody got to Congress that apparently had an S corporation that they'd had around for 5 years. So if your S corporation has been around for 5 years and you're in that built-in gains tax 10-year period, this could be a window of opportunity to you. And to give you a quick example, if I have a taxpayer that has a piece of real estate down on I-4 that has very little basis and could sell it for millions of dollars, but is in the built-in gains window, that 10-year window, it's almost impossible to sell it. But if that was held for 5 years, that double taxation problem goes away. So anybody that converted to S in the last 10 years, we really need to be aware of that kind of sleeper provision. All right, so we're gonna go to, everybody likes lists. I mean, we got the movies, the Globe Awards, the Oscars are coming out. There's top 10 lists for everything as we come towards the end of the year. So we figured it's always fun to put winners and losers. So we went ahead and captured what we thought were the key losers in this proposition. And first of all, every company, or misery loves company, I believe how it goes. Everybody has whether you're on minimum wage or you're making $500,000 in a W-2, everybody lost their 2% payroll holiday tax cut. And that is really significant, not perhaps for somebody making a lot of money, because you can see that the maximum impact is $2,200, but for somebody making $20,000, that's a sizable number, because I've had a couple of calls from folks that I know and said, what happened? And they don't realize that people that really can't afford the loss of income. So it really hurts the lower income people the most. So everybody has a loser. All of us have undertaken one big loser. Now, the only folks that really are big losers in this are the folks over $450,000. Because their top tax rate went to 39.6%, and when you consider all of the impact of all of the other dynamics of the Health Care Tax Act and phase out of itemized deductions and all of the other dynamics that go into that calculation, their actual tax rate could go as high as 44.8%. The good news is, and I said this before, is very smart people that have resources are very responsive to high tax rates and will find ways around it. And there are ways to get around many of these override taxes. So those are, think of the big losers. We want to end on a good note. So let's look at big winners. So now I talk about virtually everybody that's under $450,000 really came out extremely well in this tax act, because if you look back, when they were in the gridlock, everybody's taxes were going to go up, everybody's taxes, and not only did they not go up, they actually widened the bracket slightly. And secondly, we didn't think this was going to happen, that they extended the capital gain and low dividend rates to all taxpayers under $400,000 or $450,000. So those folks, which is probably 99.5% of the taxpayers, have really got some good news in this bill. And we also have some security in knowing that this is going to be around at least for a while. The other big winner, I think for sure, is the 60 million average taxpayers who would have been paying AMT in 2012 will now escape the AMT tax, as well as many of the high-income individuals who will just, unfortunately, by the way the math works, and their higher regular tax rates will escape it as well. So we had a late entry here into my into the big winners. There's a concept called an IC disc arrangement, whereby ordinary income on eligible international sales is converted to qualified dividends at a 20% rate. So that takes your rate, instead of from almost 40% in half, to 20%. And this is really is it a loophole? Absolutely. Is it a gimmick? Absolutely. Why was it done? It was done to encourage U.S. businesses to export their products overseas, and it's something that you set up. It's really a form sort of thing that you have to follow very carefully. But if you're selling product overseas, you definitely need to consider an IC disc, because we can convert income that's generated from those sales from a 40% rate down to a 20% rate, something we do on a pretty regular basis. And again, I'll mention the big winner, I think, is this is a very business-friendly tax bill, with Section 179 allowing us to expense equipment, new and used, up to $500,000, on top of the bonus depreciation and the research tax credit and other credits that go along with it. Other big winners we mentioned, this particularly affects homeowners in Florida. As I mentioned, if you have short sales, they're on the fence, you have the opportunity to exclude this debt forgiveness from your lender from your tax return. And I'm quite sure that won't make it beyond 2013. And lastly, Florida taxpayers, wasn't so long ago we couldn't deduct any local taxes. About 5 years ago they put in a provision, since Florida doesn't have an income tax, that they allow us to deduct our sales tax. So that provision was extended, which is very good for our audience and all of our Florida taxpayers.
I wonder if we knew this, if it would have helped the school tax referendum.
You know,
the additional, who knows?
It should have been a factor that was pointed out, for sure, that both that sales tax would have been a deductible item on the federal return, which would have the effect, if you're in the highest rate of that additional sales tax, only costing you 60% of the additional increase. Then we always have some other winners, and these are sneaky little folks that get into the tax law. And I like all of these, and I have no objection to any of these, but there's always a lot of discussion on they call them pork and other things in the acronyms they use for some of these things. But there's a lot of things get into the tax law sort of by negotiation, and three significant ones come into play. NASCAR, and Brian and I both love cars and automobiles, as most guys do. And NASCAR continues to be able to write off their racetracks over 7 years. So that was a provision that's been on the books for some time, and Congress renewed it for them, and they were very happy about that, so they could write off their racetracks at a very short period of time. Also, the Puerto Rican rum industry is very happy because they built in some new credits for them. And of course, there's a lot of Puerto Rican rum served here in the Florida coast, so I guess that's a good provision. And then, of course, of course we needed this. The electric motorcycle industry got a new credit for electric motorcycles. I'm just not sure how that rumble's going to be when you take off with your electric motorcycle, but you will get a nice credit for it. So those are three of the kind of winners that snuck in into Congress. Just some of the fun things that we deal with in these tax laws.
All right, well that's pretty much it for our presentation today. If there's any other questions that anybody has on the business section, please go ahead and type those in now. We'll wait and stand by to see if there's anything that comes through. While they're doing that, we'd like to thank everybody for joining us. It's been really interesting for us to delve in and to find all these little tidbits to share with you, and we hope that you'll be able to join us again for another webinar. At the end of this presentation, when you log out, there will be a quick little survey, and we ask that if you could give us your feedback, we'd greatly appreciate it so we could find out better ways to improve our webinar experience. It looks right now like we don't have any questions coming through. That means we must have done a great job, but I think we do have another comment.
Let me just say one thing to Ms. Hay on the 529. I didn't mean to be flippant with that answer, but that's not a charitable write-off. You're really just putting money in a vehicle that's going to grow tax-free, and when it comes out it's tax-free if you use it for your kid's college or somebody's college. So it's almost like a gift in a way. You don't get a deduction for it. You may down the road if you have tuition expenses, but it's not a charitable item. Even if you did it for grandkids or whatever, it's more of a gift. So just to clarify that.
So as we sign off, you know, I've mentioned a Bob Dylan song. You know, Bob Dylan's a very interesting person if you study music. He's been around forever, just forever. And he's probably one of the greatest lyricists in modern history, a poet actually, if you is highly thought of. In the song that he wrote, this is back in the 60s, The Times They Are Changing. I thought I would close with one of the segments of that song. And if you look it up, whatever you do, don't buy the song that he sings because he's impossible to listen to. But the Byrds, there's several people have done renditions of the song, and it's a pretty deep, cool song. But I'm going to read you the piece that I think is appropriate to close. Come senators, congressmen, please heed the call. Don't stand in the doorway, don't block up the hall. For he that gets hurt will be he who has stalled. The battle outside's raging. We'll soon shake your windows and rattle your walls, for the times they are a-changing. So with that, it's been a pleasure being with you this afternoon, and we're here to help and have you a great afternoon and a terrific 2013.